Hi, good morning, everyone. We'll start the webinar now. So as you can see on the screen, we'll go through a company update, monthly update, and sector update. This is a disclaimer, please read it. Okay, so we'll start with Cash Logistics Trust, which made an announcement last week on the conversion of CWT Commodity Hub to a multi-tenancy lease. We maintain accumulate on cash. Target price slightly lower from 93 cents to 91 cents. That's because the occupancy is lower than we expected, so we had to lower our revenue forecast. DPU is a 6.05 cents. That will give you a 7.3% yield based on last close price of 83 cents. So as I mentioned, CWT Commodity Hub was converted from master lease to multi-tenanted, and CWT was the master lessee at the property, and it retains 61% of the space. After this conversion, occupancy is 86%. This is lower than expected. Why this is lower than expected? There's two reasons. First, is actually lower than the JTC island-wide warehouse occupancy of 89.1%. This was the average occupancy as of fourth quarter 2017, so you can see it's slightly lower. And actually what we were expecting was at least 90% occupancy, which would be comparable. And why we were more optimistic is because during the previous results briefings, the manager had always maintained that the underlying occupancy quote was practically full. So the other thing is now the portfolio whale. This is the whole portfolio for Cash. Cash has Singapore and Australia portfolio, but the overall portfolio whale is currently 3.5 years as of April 12 versus 3.4 years as of the end of December 2017. Take note that this longer whale is mainly due to the effect of the acquisition of 9 properties in Australia in February 2018. Portfolio whale for Singapore actually remains largely unchanged from the effect of this conversion, because a lot of the tenants are just merely changing over to the Cash as the landlord, and all along Cash has been reporting their whale based on the underlying lease and not based on this master lease. One of the good things for this year is that there's no more master lease expiring, and the next master lease for Cash that will expire is in 2019. That's for Precise 2 at 15 Galway. That's on 31st of March. What we like about Cash right now is that the balance sheet is well capitalized. Gearing is at 36.3% as of fourth quarter 2017. This is one of the lowest gearings among the industrial REITs. And then they have an ongoing divestment of high-speed logistics center, where they've said that they will use the divestment proceeds to pare down debt, and then the gearing will come down even further to 32.4% by our estimate. So that will result in a headroom of about 270 million if you use a 45% limit. So they can use this debt headroom to make more acquisitions and grow the portfolio. Now we'll move to Sai-Ting, who will talk about the ETF model portfolio.
Right, good morning guys, this is Sai-Ting here. We just have a brief look through for the March update for the ETF model portfolio. As the title itself says, we're actually de-risking the portfolio in terms of the equity risk. So looking at the performance for at least until end of March 2018, year to date, the Singapore portfolio as well as the US portfolio have been doing pretty okay. There's a lot of that is due to our diversified exposure to fixed income as well as commodities and gold. So besides the Singapore balance and conservative portfolio as well as the US conservative portfolio, the rest of the portfolios are actually in or still in the greens. If you look at the two tables at the bottom, which represents the ETF that we invest into, you can see that there's some discrepancy in terms of the performances. Some of the underlying funds might not be exactly the same funds that we buy into due to just purely due to availability. For example, in Europe, the Euro equities we are looking at for US listed ETF is actually the Vanguard one, whereas in Singapore we're just looking at the iShares. And obviously for things like gold and US, although they might be similar funds, but because of their different book closing date, therefore we might see a bit difference. But in the long run, performances for the ETF tends to be equal or in tandem. So bring back our topic to for the ETF portfolio, which is the risk kit. Some of these key charts here that we are monitoring actually shows us that sentiments have actually changed. So we are a bit wary of where the market will be heading going forward. If you look at our investment grade spreads as well as our high yield spreads, these are the credit spreads. They're actually showing an uptick. And when this happens, usually it's a sign of risk adverse sentiment that's coming back into the market. The emerging market spreads as well has also been ticking up. It's just that the scaling is a bit smaller. So on the other kind of spreads that we're looking at is actually the interbank liquidity, or the way we measure the interbank markets through the LIBOR OIS spreads as well as the TED spreads. So this tells us significantly how liquid the interbank market is right now. And at this moment, you could see that there's a certain level of stress. On average, we see the TED spread as well as the LIBOR OIS spreads to range about 10 to 50 basis points. Now we are about at a high of 60, and the rate of increase is startling for us. But this might subside, but it's just telling us that markets are getting more volatile. And if you look at the volatility measures, which is the VIX measure as well as the V2X, which measure the Stocks 50 index, the volatility of the Stocks 50 index, we can also see that volatility have also shifted. I think Jeremy has mentioned in previous weeks that we should see a paradigm shift from the low volatility environment between the low teens and around the mid-range of low teens. Now we are looking at volatility that should be about between 15 to 20 level. So with this in mind, we are going to take an early approach to de-risk our portfolio. Mainly, we will be lowering our equity exposure and putting all the additional the allocation back into fixed income. If you guys have been following our course, we was initially very worried about bond rout that might happen this year. Essentially, meaning that the end of the 37-year bond bull market might be coming to an end for the 37-year bond bull market. That has not been the case, and it has not played out thus far this year. Earlier, if you recall, earlier this year, there's a lot of investors that are talking about this 10-year treasury yield essentially moving up above the 3% level. When this thing happens, this happens, usually, not usually, our inclination is that the bull market might be coming to an end. However, it only hit a high of 2.94 in February, and since have subsided significantly since then. And our view has changed as well. Looking at some of the data that's coming out and looking at the commitment of traders report, we have also have this view that this story has been oversubscribed, and a lot of people have been actually shorting the US Treasury in anticipation of the end of the bull market. So if you look at the COT's report, we know that there's an extreme short position for the US Treasury 10 years futures, and when we're at this situation, usually there's going to be a short squeeze, and when that happens, the yield represented in the orange line usually will drop, which signifies a bond increase in bond price. So with that, from that perspective, we're looking at we think that fixed income is still a safe place to be, and bond rout is not going to happen in the near future. And if you look at this table, we're showing you actually the new asset allocation that we have subscribed for our portfolios. Equity is down for the aggressive portfolio. Equity exposure is down about 10%, and we put that all back to bonds. That's the same for balance as well as conservative, as the number shows. What's interesting is that we do not want to lower our exposure to gold or commodities. These are something that we have added. Commodity is something that we added sometime in November, and we believe that it's still a very good diversifier against any form of inflationary risk. So we're going to leave that allocation untouched. We're just going to lower equities and put them back to bonds. With that, I've come to the end for ETF. I'll pass it to Paul for Singapore strategy.
Hi, good morning. This is just to give you an update of our Singapore monthly. This is the usual or monthly report that we issue on all the updates on strategy for Singapore. In our April monthly, we titled the report two-legged tail risk. I guess for those who are not aware, who we're referring to is actually Donald Trump. Basically, what we're saying is that the tail risk is kind of unraveling. We have as we all know, the trade war, the occasional attacks on specific companies like Amazon and his threats to exit NAFTA. There's a new security advisor which will be Bolton, which will be involved in the discussions with Iran, and of course there's also this Taiwan issue that once in a while that flares up. So basically, we're getting a huge amount of volatility due to the policies of the tail risk, the two-legged tail risk. The two dates to be mindful of. I mean, just to add more dates into your calendar is there's also a 12th of May event, which is the Iran, where the US will decide on whether they want to impose sanctions on Iran. The other date to take note of will be 15th of May. That will be when the US decides on. Sorry, hold on. What happened to the slides? Oh, sorry. Okay, sorry. I'll just go back. The two dates to be mindful of will be the 12th of May, where the US has to decide on on whether they want to impose sanctions on Iran. That will probably be impactful on the oil markets. And also on the 15th of May, that's where the US will decide on imposing tariffs on China. So these are two important dates to be mindful of. Okay, on the economic front, in terms of the impact of the trade wars. There are multiple papers written on impact of trade tariffs. There are almost 20 such papers with all kinds of assumptions. But if you kind of average them down, the impact could be around 0.2% of GDP. If you assume the 50 billion of trade tariffs on 50 billion worth of goods, and you assume a two-way trade impact, the impact on each country for China and for US will be about 0.2 percentage points. Again, there's also this issue of country of origin. So some of these countries could actually bypass the tariffs if they do not impose this country of origin strictly. Again, it's not about the size. I guess the market realizes the size is not so significant right now, but it's more the uncertainty over the duration and over the duration of this trade span. The other macro point to take note of is, of course, we have a more hawkish than expected Federal Reserve. Apart from the Fed Reserve meeting, the Fed Powell actually did make a speech early this month. Basically, his point was that you have to make preemptive increases in interest rates so that there is no drastic spike in interest rates so that you do not trigger a recession. So, I mean, whether or not how hawkish he will be will ultimately depend. If the market really corrects, then you really test how hawkish he will be. But basically, his point was that you need to raise interest rates now so that you don't have to spike them up later on and trigger some recessions. But anyway, that's the view that he has. So we have a hawkish Fed. Anyway, there's almost a 40% probability of three rate hikes already priced into the market. In terms of back to Singapore, in terms of sector-wise, property sales remain vibrant, and as a impact of the en bloc is also that it will also cap supply, as even developments that have not been en bloc but are in the process or in the midst of undergoing the en bloc kind of takes out some supply in the market too. Okay, in terms of banking, we expect the results should be healthy for the first quarter. What will help drive the results should be the improving margins, as we have seen both in Singapore and in Hong Kong, that the interbank rates, the LIBOR and the HIBOR have all been rising, and this will be helpful for the bank margins. Only point to note will be for us will be the wealth management products. Wealth management, as you know, has been growing 20-30% for the banks. This could slow down a little bit, as during such volatile markets, clients will prefer to buy the lower margin and lower risk products. So we could see some slower momentum on the wealth management. In terms of REITs, of course, it's turning more attractive, as expectations of a higher interest rates are already kind of built into the market. For electronics, based on the latest data points, the electronic semiconductor sales remain on a very strong uptrend. Okay, in terms of our stock-specific recommendations, no real change. The only thing we kind of added was SGX. SGX will be releasing their results on Friday. This Friday, we should expect some strong numbers coming out, as the derivatives volume is up 30%, and of course the securities market volume is up about mid-teens. So we should expect some strong numbers out of SGX for this Friday. Okay, I'll move on to the next and final slide from my side. As you all know, we do build a model portfolio. We call it the Absolute 10, basically our top 10 stock picks for absolute returns. If you see the little table on the right, this portfolio was started in January, so these are the past 3 months of performance. We did well in January, but the last 2 months we've been hit by the volatility. There's been no real change in the portfolio. Only thing is, after 2 months, we took out DBS, as was highlighted in our earlier reports, and we changed it with OCBC. If you look at that red colored box, that's basically the year-to-date performance. So the 2 stocks that have helped us the most was DBS. It's not in that table there because, as you know, we took it out after 2 months. So that was the big gainer for our portfolio. And also ComfortDelGro, if you can see, year-to-date performance for ComfortDelGro is 3.5. Okay, what has hurt our performance has been, if you look at the top, is of course Asian Pay TV. It's down 10%. As you can see from the last bullet point, we still do not change our recommendation on Asian Pay TV. The macro remains stable. The Taiwan dollar is actually appreciating slightly against Sing dollar. And although we are in an environment of rising interest rates, the TIBOR, or their Taiwan's equivalent of SIBOR, is actually flat. It's actually about 0.6%. So actually there's no interest rate pressure or currency pressure on Asian Pay TV. So we still expect a 12% yield on this stock for FY18. Okay, and if you scroll down that red box, you can see the other big loser in our portfolio has been Geo Energy. The performance has been hurt by the 4th quarter results, which disappointed on the production, but we do expect a production recovery in 2018, and also coal prices are stable in our forecast, but actually at present still coal prices are actually appreciating better than expected. Okay, that's it for me. I will move on to Guangzhe on Offshore and Marine.
Okay, thanks, Paul. It's Guangzi here. So next, we'll talk about our sector update on offshore and marine. So basically, we think that the outlook and the current market situation is still soft. There are 4 highlights on this sector. Okay, firstly, right now the banks are the de facto owners of the vessels due to the supply imbalance of the in this market. So the banks, they are controlling the vessels and keeping them afloat right now. So for all these offshore vessels and rigs that controlled by banks, they can, part of them they can generate minimum positive cash flows. So for the banks, they hire either the third-party operators or the original owners to keep them under the operation. And right now, quite a few of these assets, like vessels and rigs, should have been scrapped, remain operational due to the current oversupply of them. So the next highlight is the upstream production activities have been recovering since the third quarter in FY17, but still depressed. So as of now, the day rates have increased a little bit, but the utilization rate of these facilities still remain are still hovering around at a low level, and we expect that the oil majors will increase the capex on exploration and development going forward. So we think that the drilling activities may only resuscitate early next year. That means from now until end of this year, the upstream production activities will remain soft. So the third highlight is that the offshore support vessels market is still facing difficulties because the market is still facing oversupply of these vessels, and also for the OSV's owners, they actually have rejected the offers for long-term contracts because these owners, they expect the day rates will recover, and they do not want to lock in at a lower rate for a longer period. So we think that the demand for OSV will return only when the oil companies will start to increase their drilling work, and also the supply of the current OSVs will decrease, as some of these OSVs will be scrapped and keep out of the market. So the fourth highlight is that we expect the rally of oil price will dial down. So recently, due to several global events, the oil price was stimulated to the third-year high of $70 per barrel. And last week, the Saudi Arabia, they announced they aim to push the oil price back to $80 per barrel. But we think that the rally will, the speed of this rally will slow down, since we expect the supply glut will come back. So there are charts we can show the current situation of the oil market. So firstly, we do see that the profitability of these oil majors improved since third quarter last year, but as of December last year, the EBIT of these oil majors were not even half of the peak in FY14. So as we say before, we expect the capex on E&P from these oil majors will increase this year. That means the capex has been bottomed out since last year. So right now the oil price already climbed back to 3-year high of $70 per barrel. So why we expect the recovery of oil price will slow down is because we, according to the EIA, short-term energy outlook in April, they expect that from second quarter to end of this year, the supply glut will come back. You can see here. So actually from third quarter last year until first Q of this year, the global oil market was actually experiencing the stronger demand, which is more than the supply. That underpinned the recovery of the oil price for these 3 quarters. The next chart shows that the day rates and utilization rate of these offshore equipments are still at a depressed level. So likewise, the global rig counts, though the number of these rig counts increased in third quarter. However, the momentum or the utilization rate of these rig counts dropped in first Q. So the next chart shows the numbers of offshore support vessels sold for scrap. So you can see here in first Q the number of these OSVs sold for scrap peak. That means right now the OSVs market face oversupply significantly. So this chart also shows the same sign that the oversupply of OSV will be extended to end of this year. The next chart is the US crude oil production. As we knew that if the oil price continue to climb up, the shale oil production will increase accordingly. So you can see here the first Q, the US crude oil production reached the peak level historically. The last chart shows that the US crude oil inventory in first Q dropped back to FY14's level. That is because in first Q the demand for crude oil is still strong, but you can see that in April the inventory started to pick up. So next I will pass on to Lin Xin to talk about consumer sector.
Thank you, Guangzi. Morning everyone, this is Lin Xin. So I'll just briefly bring you guys through some of the monthly indicators that we track for our consumer sector. So as you guys know that for January and February data is kind of like disrupted by the timing difference for Chinese New Year, and the February data has just came in, and it actually confirmed or affirmed that the retail sector within this region is set to grow for the rest of the year in 2018. So what we are seeing is that we are seeing a rosier picture in Hong Kong, where you see that the Hong Kong's retail sales actually rebounded with a double-digit growth in February. And this high double-digit growth has actually has not been seen in the past few years. And in Singapore actually we saw a contraction in January, but that has actually rebounded in the February data. As for Philippines, we saw a turnaround in February, and after seeing that the 1 year contraction or slowdown in the retail sales in Philippines side. As for Vietnam, we are seeing also a strong growth in the Vietnam retail sales because of their higher spending power, driven by wage growth in Vietnam side. So in Vietnam, we are also seeing a multi-year high retail sales growth. However, we are also seeing some challenges within the Southeast Asia side, in particular Indonesia, Malaysia, and Thailand. So what we are seeing is it's not contracting, but there's some slowdown, and we believe that all these three countries have in common is that they are going to have an elections coming soon. So the elections may be the catalyst that we will be waiting for. Why do we say so? Later I'll bring you guys through some of the pointers for how the elections, especially the campaign, would drive retail sales within these three countries. So besides all these, what I would like to highlight is that what we have noticed in the Singapore market is that if you can look at this chart here, the blue line is showing you the food retailers. So food retailers are those outlets that serve you food, but you cannot consume on the spot. So some of the example would be like those ready-to-eat meals where you'll be bringing it back and heat it up and eat it at home. And as for the red color line, is the F&B services index, where is the typical restaurants or food caterers where they prepare a ready or a ready meal for you to consume on the spot. So as you can see that the red line is still trending at the negative territory. As for the blue line, it has actually spiked up. So this actually might signal a potential change in the Singapore consumer preference, where more and more locals prefer to dine in instead of going out to the restaurant to eat. So we'll continue to monitor this indicator to see that whether businesses like, for example, Old Chang Kee might benefit as they are categorized more towards the food retailer side. Next, like I mentioned just now, we'll touch a bit on the elections, where we believe that the impending elections could reignite consumer sentiment, thus leading to higher consumer spending. So what usually we'll see for an elections is that there might be some political or social activities which could bring consumers to spend. Before elections, we'll usually see that consumers will hold back on their spending, and during the elections period, we might be seeing the government might be handing out cash subsidies to drive spending. So we believe that these kind of subsidies would help to boost retail spending further. And after elections, we'll be seeing that government will be pushing forward for the much delayed infrastructure projects, as we have seen in which has been mentioned several times in Thailand, in Indonesia, as well as in Malaysia side. So this should be able to prop up GDP growth as well as boost consumer sentiment. And just to touch a bit on what kind of cash subsidies that we are seeing, and the nearest general elections that's coming on is actually from Malaysia's side, which will be held in 9th of May, as you know. So Malaysia actually had a very generous pre-election budget package announced early of this year. Yeah, they're actually planning to give out cash handouts under this BRIM program, which is officially said to be helping the low-income families. So last year, in 2017, they actually hand out a total of 6.8 billion ringgit, and they intend to keep this amount or a minimum of this amount for this year. The first disbursement already happened in February, and the next upcoming one would be on June and August. They're also going to hand out a better bonus package to civil servants. They are also having some fiscal stimulus like income tax relief, as well as some subsidies to the rural communities. So we believe that all these should be able to help Malaysia's retail environment. Next, we'll look. There's some indicator for February side for the Thailand's beer market actually concern us. So what happened is that if you look at the red arrow, the red arrow here, it actually indicated the excise tax hike for in particular for beer. And if you can see that historically speaking, after the implementation of the excise tax hike, it usually takes about 4 months for the beer sales to recover. So what happened is that after the February data was released, we are actually seeing that the demand continued to deteriorate after the excise tax in September last year. So what we are seeing is that the recovery is actually slower than what we are expecting. So March and definitely we'll watch out for March and April's data, which we believe that this is crucial to indicate the on-the-ground consumer sentiment, especially for the April data, where Thailand actually celebrates their Songkran festival. So if the data for April does not recover, then we will have to review our assumptions for Thai Bev. Last, I would like to also touch a bit on Vinamilk and as well as FNN. So Vinamilk actually had their 2017 AGM in end of March this year. So what they have announced recently was that they have grown their earnings to about 0.5 billion US dollar last year, and they have gained market share of 2 percentage point to 58% as of last year. And they are targeting to grow their earnings by another 5%, as well as to grow their market share by 1 percentage point every year for the next upcoming 5 years. So they're targeting to reach at least 60% of Vietnam's market share for dairies product. And as you can see from this chart, the dairies demand in Vietnam is actually continuously growing at a strong teens digit. And we believe that the strong demand in Vietnam should continue to support FNN's dairies profit. And if you are following FNN, as you know that they are facing some challenges for their soft drinks as well as their mineral water side. Nonetheless, dairies should be able to support their profitability, especially coming from Vinamilk. So currently they have about 20% stake in Vinamilk, and they intend to accumulate further via open market transaction, as well as they are waiting for any upcoming government stake sales. So the Vietnam government currently holds about 36%, and they have actually said that they intend to sell it, to have the stake sales further, but we are still waiting for the divestment plan moving forward. Nonetheless, we may be seeing there's some competition coming from Jardine CNC. They have recently acquired or accumulated about 10% interest in Vinamilk, and they have actually onboarded one representative into Vinamilk's management board. However, if you look from a brighter side, is that the strategic partnership between Vinamilk and Jardine Matheson Group can actually help to boost Vinamilk's export sales. So for Vinamilk to export out, they are facing some challenges because you can't there's some quota or some restrictions on exporting dairy products into various markets. So how Jardine can come into play is that, as you know, they have dairy farm. Dairy farm has thousands of outlets where they can help them to distribute Vinamilk's product. So this might help to boost Vinamilk's earnings further. So we believe that with the strong position in Vinamilk, FNN should be able to benefit from it. So with that, we maintain our overweight rating on consumer sector, and we'll now open the floor to any questions.
Okay, we got a question on Asian Pay TV. Let me quote this. Let me quote this question. Asian Pay TV is always been on a downtrend in price performance. Why do you guys say every week that Asian Pay TV is good? You keep having a buy on this counter. Kindly explain. Thank you. Oh yeah, we will keep having a buy, especially if it keeps coming down actually. Yeah, because we like it because the yield is attractive, and also it's a monopoly cable TV cable broadband and also pay TV. Yeah, so actually if it actually comes down, ironically we'll probably call it a buy even more. Yeah, thanks. Okay, next question. Just now someone mentioned just now someone mentioned SGX result out soon. So do you have the date? The results will be out on this Friday after the market closes. Yeah. Thank you.
Hi, this is Richard speaking. There's a question on cash about the drastic drop of 10% for occupancy. Just to clarify, the 86% that I mentioned is only for CWT Commodity Hub. That's not the occupancy for the whole portfolio. The whole portfolio occupancy is still around 96%, even with after taking into account the effect of this conversion.
Hi, it's Guangzi here. There is a question asking about the outlook for Marine. So we expect that Marine will secure contracts total at around 2.5 billion Sing dollars, which is comparable to last year's amount. So basically, there will be a lag for Marine to secure more orders when the oil price recovers, and also based on the current contracts that Marine secure, most of these contracts are from FPSO, the floater segment, and the amount of these contracts is not are not very substantial, range from a few hundred million Sing dollars to less than 1B. There is a question asking whether the Ezra will be delisted soon. We don't have any comments on Ezra. Thanks. And for Easion's outlook, we still, because as according to the last briefing, they expected that today they will resume trading. However, today it is still halted. For Easion, for Easion's outlook, we think it's not easy to forecast the outlook now, as after so many rounds of these restructuring and refinancing plans, it's quite hard to predict whether the bondholders will exercise the conversion, and for the warrants whether they also will exercise. And that's why we are not sure the extent that the share dilution moving forward once it resumes trading.
Hi, this is Richard speaking. There's a question on any comments on sets. So for sets, we currently have a neutral on it. Target price is 533. Current price is 516. So there's really not much upside from there. It's maybe about 3% upside from current price to our target price. We think that auto sets has got quite a decent growth outlook in terms of the strategy and where they are moving into, and the joint ventures that they have gone into. But we think that much of this growth has already been priced in already, and that's why we have a neutral on sets.
Guangzi here. I also need to say that right now the offshore marine sector is quite soft, and the operating environment is quite challenging now. So even though the oil price may spike up in the near term, we do think that as long as the oil price are fluctuated or below like $70 per barrel, for those like offshore and marine sectors, they are not easy to secure significant amount of orders or see the substantial improvement of the day rates.
Yeah, hi. Thanks again for all your questions. Okay, we got this. What is the view on Singapore equities? Is it still bullish? Yeah, we are still bullish on the Singapore equities. There's no change in our target price of our index. Sorry, our index target of 39. We still think that the banks and property will be the big drivers on our index target. If you want to go into really big macro picture, global economies are still very strong. And even if you, the other thing that probably the market has less focus on is, if you look at some of the emerging countries like Russia, Brazil, China, you can see that the imports into these BRIC countries are actually skyrocketing. So because with the recovery in commodity prices, you are experiencing a big bounce in emerging market growth and aggregate demand. Yeah, thank you. Okay, there's a follow-up question on Asian Pay TV. Besides being a monopoly, what are the other good attributes of Asian Pay TV? For us, is the stability. I think that as you can see, the subscriber growth in the Pay TV subscribers is actually very stable for Asian Pay TV. The other, what will be an upside will come if you can gain traction on broadband. As you know, broadband has the best margins. Broadband has the highest price, and there's no content cost. So broadband is the other upside surprise that we're hoping for.
Hi everyone, Tehong here. There's a question on Capital Land, and the question is, why is it that despite the heavy share buyback, the share price does not seem to be moving? We are still optimistic on Capital Land. We think that currently there's been a lot of euphoria about Singapore residential property, and so far the theme we saw last year was that those with more land bank, more existing inventory has moved. But what we saw from CapitaLand in the first quarter was that they have firstly restocked on the local residential land bank with the en-bloc purchase of Pearl Bank. So that will give them a leg up to capitalize on the upcycle in the market. And I believe they got the project at a decent price as well. And then secondly, there was also a 20% hike in dividends. That's the first time you saw such a steep hike in dividends since 2009. So I think that's reflective of the optimism on the recurring income that they are bringing in, because you see that in last year they have actually opened 1 million square meters of retail space alone, and that's the highest level of retail space opening in a single year by the company. So as this retail space start to ramp up in occupancy and in performance, this will contribute to the recurring income as well. So all in, I think we're still optimistic, we're still bullish on CapitaLand.
Hi, this is Lin Xin. There's a question regarding apart from Old Chang Kee, what other listed F&B companies that might benefit from the recent stat on F&B dine-in preferences. So to be frank, actually, there's no such prominent name that actually pop up regarding these stats. So how you look at it is that this one, it constitutes all the restaurants, food caterers, as well as fast food outlets, even cafes. And if you look at the red lines, it constitutes businesses that are that opens food retail outlets that serve few food that that cannot be immediately consumed or generally can't be consumed immediately on the premises itself. Because this survey is being taken by as a company rather than by the separate outlets. So if you look at like Old Chang Kee itself, it also has a restaurant component which is also under the red line, but generally most of its businesses actually generates from this blue line itself. But if you look at other big F&B names, mostly are actually under this F&B services index. So on top of my mind, there's just no such prominent name that can that is constitute under these F&B food retailers. Okay, there's another question on Bread Talk. Yes, Bread Talk can consider as one of the outlet. Yes, Bread Talk can consider as under these F&B retailers. But if you look under the Bread Talk's earnings, what is actually generating or driving their profit is actually their restaurants, the food atrium, or the turnaround in their in the food atrium. So to be honest, if you look at the financials, the main growth driver is actually not reflecting of the bread bakeries sales. There's a question on jumbo. Sorry, we don't cover jumbo per se, but for jumbo side, if you look at their recent growth drivers, will be mainly coming from the new JVs that they have took on. So other than going into a business themselves, they're actually taking up a franchise model. So this is something exciting, or maybe a catalyst for the stock's earnings itself. So if there's no further questions, we'd like to end our webinar for today. Thank you so much for your time, and we hope that you tune in again for next week's webinar, same time. Thanks.